Federal Reserve Board Chair Janet Yellen, speaking to reporters on Wednesday, March 16th, said the U.S. economy is doing just fine despite fears of global growth slowing, and it sent stock prices sharply higher. Yellen read a statement and answered questions for reporters for more than an hour and a half, and she said consumer-fueled GDP growth would hold for 2016. While the economic message from Yellen was good, the really big news here is that America's #1 banker holds a press conference monthly. Every month, Yellen, who is one of the most important people in the world, answers questions from financial reporters, and she speaks in detail about what she sees happening in the U.S. economy. A key strength of the American economic system has always been its transparency. But Yellen, who has had the luxury of an economic expansion since beginning her term, February 3, 2014, has shown a commitment to communicating the Fed's policies long in advance of taking action. The clarity of communication from Yellen inspires trust and leverages unique strengths of our great nation. America's institutional transparency stands in stark contrast to the People's Republic of China, the world's #2 economic power. United States government data about economic growth is reliable, though imperfect. U.S. economic data is trusted. China's economic statistics are not so reliable, and provincial governments responsible for supplying the data are plagued by corruption and cronyism. The burgeoning Chinese economy has a comparatively tiny stock market where Chinese companies' shares are sold. When prices of stocks have become unhinged in recent months, they were manipulated by Chinese authorities to try to avoid a market crash. The U.S. government doesn't get involved in supporting stock prices. Although U.S. government spending is often criticized, Chinese government overspending and corruption is responsible for construction of uninhabited ghost cities and many bridges to nowhere. American accounting principles are a model worldwide. Indexes for tracking employment and business activity, as well as corporate and household balance sheets, are squeaky clean compared with China, where the government has been in power only since 1949, and there is not an institutional history supporting freedom of information, much less accounting principles. Talk about transparency. At this month's press conference, Yellen directly addressed fears that a widely expected global economic slowdown will hold back U.S. economic growth in 2016. A China-inspired global slowdown was thought to have ignited an 11% plunge in January in the S&P 500 stock price index. China's real gross domestic product has been growing at the astronomical rate of 7% a year, but it is expected to drop to an only slightly less spectacular 6.6% rate of growth over the next couple of years. Yellen, at her press conference, said China's slowing economy would not threaten the U.S. expansion, which began after the Great Recession of 2008 and 2009 and has fueled a 6-year bull market. Meanwhile, the good news for the economy continued with the March 17th release of the Conference Board Leading Economic Index. This forward-looking index of the U.S. economy increased by 0.1% in February, following back-to-back declines in December and January. Housing permits, stock prices, consumer expectations, and new orders remain sources of weakness, the Conference Board said. Although the LEI 6-month growth rate has moderated considerably in recent months, the outlook remains positive, with little chance of downturn in the near term, the Conference Board said. While the LEI sometimes declines 2 or 3 months in a row or more, even in an expansion, the U.S. LEI has signaled weakness in advance of previous recessions. So, it is a reliable economic measure of U.S. GDP growth. The LEI in February rose only slightly, but the index continues to hover near a very high level not seen since before the Great Recession. U.S. retail sales slipped last month, pulled down by sharply lower gasoline prices, and Americans spent much less in January than previously estimated. According to press reports like this one from Bloomberg on Tuesday, March 15th, the retail sales figures are calling into question the narrative that bigger gains in consumer spending would propel economic growth at the start of 2016. The press widely reported that the sales figures suggested that consumers remain cautious about spending despite steady hiring. However, consumers have rarely been in better shape. Disposable personal income and spending have been in recovery for years. They are growing at a rate only slightly lower than at the peak of the last economic boom. Because personal spending accounts for 68% of U.S. economic activity GDP, it is key to the rate of growth, and it is in very good shape indeed. Real disposable personal income is growing faster than it did during the last boom, and the savings rate at 5.2% has remained substantially higher than it was at the peak of the last economic expansion. On Friday, March 18th, for the first time in 2016, the Standard & Poor's 500 closed with a positive return for the year. Although stocks had gained just 0.3% for the first 2.5 months of the year, they had come a long way back from January's low. A strengthening economic outlook at the Federal Reserve's accommodating monetary policy fueled gains in stocks for 5 straight weeks, and the S&P 500 had gained nearly 11% since February 11th. While we do not know the future of the stock market, we do know the nation's top central banker will tell us what's happening in the U.S. economy, and long-term investors can be bullish about that.